Hello and welcome to Berkadia's presentation, Changes at HUD, How the Publication of the 2020 Map Guide Affects Your Loan. Please note that all lines have been muted and will remain muted throughout the duration of the event. I'm Steve Irvin, Senior Vice President and Head of FHA and Seniors Housing Finance. I'll be the host and will be introducing our panel. Without further ado, let's get started. Today we are fortunate to be joined by three of my colleagues here at Berkadia. Bob Warren is the Senior Vice President and Head of FHA Underwriting. Debbie Van Hoosen is our Chief Underwriter for FHA Multifamily. And Terry Wellman is our Chief Underwriter for FHA Affordable. Terry recently joined Berkadia just a few weeks ago after serving as the Chief Underwriter for PNC Bank. Berkadia is a leader not only in FHA finance, but in the experience, knowledge, and advocacy within the FHA programs. Between the four of us on this panel, we have over 100 years of HUD experience. All of us have either served as chair or vice chair of the MBA's FHA Insured Committee, which works closely with HUD leadership to effect positive change for the industry. Bob and Terry currently serve as president of two of the regional lender advisory groups to FHA. I served as president of another of those groups previously, and Debbie and Terry are instructors for various MBA HUD training courses, including the affordable and new construction training courses being offered later this year. In addition, Berkadia has many other leaders throughout the industry in similar positions. We just couldn't put them all on this panel. Many of you likely saw HUD's release of the 2020 Map Guide and are wondering how this new guide impacts your decisions on how to work with HUD in the future. This panel will bring our experience to provide you broad context about the many changes of the Map Guide and how they will be treated in the future. Afterwards, we'll close with a Q&A session. For the closing Q&A, we have some questions that have already been submitted by our invitees. We will start the Q&A by answering those questions, but you can also submit questions at any time using the Q&A button at the top of your screen. We will address all questions at the end as time permits. So let's get started. First, I'll speak about Berkadia's production and HUD's production in general, and the changes we've seen in the industry. Like many lenders, Berkadia HUD production has skyrocketed in the last 12 months. We closed $1.1 billion of HUD loans in 2019. That number shot up to $3.5 billion in 2020, and we're continuing 2021 at an even higher pace. We've closed $975 million worth of HUD loans just by the end of February alone. All that really means is that we're constantly working with HUD and getting feedback not only on what the guides say, but on how HUD is implementing what's written in those guides. While our pipeline has grown across the board for all loan types in all markets, the strongest growth has been in our 223F refinance loan programs. Over the past year, we've seen extremely strong demand for refinances, even of loans that were not already HUD loans. This trend is being driven by the low interest rate environment for HUD loans compared to agency loans, which we expect to continue. We do not expect this pace to slow for quite a while. In order to put context into the changes of this new map guide in 2020, it is often helpful to examine the environment that existed going into the last changes to the map guide in 2016. The 2016 map guide was a much more ambitious project with a goal of capturing many of the modifications that had occurred in the MAP program. The 2020 map guide, while offering significant changes, was more of a maintenance update than an overhaul of the process. In the years leading up to 2016, the industry had experienced strong growth in the MAP program. The frothy CMBS market and readily available debt lending leading up to the financial crisis caused HUD to fall out of favor in 2008. At that time, multifamily hit a low point of just $2.4 billion in loan commitments. With the onset of the financial crisis, the HUD programs with their attractive features like full amortization, low rates, and predictable prepayment costs grew in popularity, and volume exceeded $10 billion per year from 2010 through 2015. With HUD's increased acceptance in the market, larger loans for better credit borrowers started being made through HUD. During that time, the average loan size for HUD also grew from $5.5 million in 2008 to $10.5 million in 2015. So the volume of HUD loans increased and the nature of the loans were very different from pre-crisis loans. At the same time, HUD increased its affordable focus and worked to make the MAP programs a little better match for properties with tax credits. As a result, affordable properties increased their share of HUD volume from just 16% in 2010 to 36% in 2015. During this time, HUD also changed dramatically the way that HUD loan credit was viewed, bringing a more holistic view into borrower credit and changing the way HUD looked at their borrowers. The 2016 MAP guide was issued in this environment and incorporated all the previous changes from housing notices and other guidance. The HUD environment leading into the new 2020 MAP guide is different than what we saw in 2015 and 2016. HUD loan volume is up dramatically again. We're up 13% in the number of loans compared to 2015, but that increase is growing even more today. And at the same time, overall dollar volume is up dramatically to $20.5 billion in 2020. That means that the individual loan sizes are up yet again. From $10.5 million in 2015, as I just said, the average loan size is now up to $19.3 million. At the same time, HUD's affordable loan volume has dropped. It is now only 22%, or just 232 loans last year. That number is down from 340 affordable loans in 2015. We fully expect HUD to work to address this drop with the new administration. The year leading into the 2020 MAP Guide publication has been one marked by efforts at HUD to reduce bureaucracy and to eliminate unnecessary restrictions on HUD loan processing. Finally, in the middle of the drafting of this guide, the COVID pandemic hit. Nobody knew what to expect, with everyone moving to work from home, coupled with unsure rental, lending, and liquidity environments. One of the most positive surprises we experienced was how HUD handled itself during this transition. In the first 6 months of the fiscal year, which culminated with the start of the pandemic also, HUD issued 430 commitments. In the next 6 months, HUD productivity increased nearly 50%, with HUD issuing 635 commitments through the end of the fiscal year. That increase is continuing through today. To sum it all up, lenders have larger pipelines than we've ever seen. I discussed Berkadia's production so far earlier, and we expect 2021 to outpace our 2020 record production. Leading to some of this is a continued rate environment that favors HUD lending programs, along with HUD's demonstrated ability to continue to execute as I just described. When we couple these factors with the increasingly restricted caps from FHA on Fannie Mae and Freddie Mac lending, HUD continues to be more attractive for borrowers that desire the higher leverage, lower cost, long-term loans that HUD offers. As I said before, the previous 4 years were marked with decreased regulation and decreased friction in HUD programs. Those changes have found their way into the new MAP guide in the form of the removal of unnecessary rules, improved features to some loan programs, and clarified guidance on previously inconsistent interpretations. Any implementation of new rules brings with it some adjustments and growing pains, and this one is happening when HUD systems are stressed, not only by pandemic-related changes to workplaces, but by record volume. Generally, however, we believe this guide represents a strong improvement over the past guide for borrowers interested in FHA programs. The new rules will result in greater predictability and higher loan proceeds for HUD. I'll now pass the discussion over to our panel to discuss our thoughts on the new guide and what we can expect from the new administration at HUD. Bob?
Thank you, Steve. So I'll start with the new administration and HUD's continued focus. So for the new administration at HUD, Congresswoman Marcia Fudge has been nominated as HUD Secretary. She's likely to be confirmed before the end of March. The industry is very supportive of Congresswoman Fudge as HUD Secretary and excited to see her come aboard. Ethan Handelman, he will be the new Deputy Assistant Secretary for Multifamily. He actually started on February 16th, and he comes from the industry and FHFA and has been involved in affordable housing throughout his career, and we're excited to have him on board as well and look forward to hearing him on some panels here in the very near future. HUD, as Steve alluded to, they continue to have a focus on affordable housing as well as green. On affordable, HUD continues to make positive changes to align its requirements with the rest of the industry. Our very own Terry Wellman has been leading the charge in those efforts, and he'll elaborate on those changes later on in this webinar. On green, HUD continues to refine the requirements for energy efficiency, and with the new administration, we expect to see even more of a focus in the future. This will be a positive for the HUD programs and for the borrowers, very positive. On to FHA financing in the times of COVID. As Steve talked about the increased volume, it's incredible to see what HUD is doing. So through fiscal year 2021 to date, which is the first 4 months of HUD's fiscal year through January 2021, HUD issued approximately $12 billion in firm commitments, and they closed $9 billion. At that pace, that would put them at $27 billion closed by the end of the fiscal year, which is a number that they've never seen before. What's even more amazing about that is that in February alone, they issued approximately $2.8 billion in firm commitments. And to put that in perspective, as Steve said earlier, in 2008, they only issued $2.4 billion in firm commitments for the entire year. And that's an incredible statistic. And that's just in the multifamily loan programs. There's the loan modifications, the hospital programs, the healthcare programs. And so HUD they're reaching heights they've never seen before. They have plenty of commitment authority to manage this volume, so there aren't really any concerns with running out, as has happened several times in the past. On timeframes, so the record volume has led to increased review times by HUD. They recently increased the capacity of the contract underwriter to address the capacity issues. And as we see by February's firm commitment totals, they're still getting a lot of business out the door. And for Berkadia, we added just since January of 2020, we've added 25 additional people just in our underwriting group to handle the additional volume to be able to manage the client's needs. On COVID, when COVID came out, they put some mitigants in place to manage potential issues that may have come up as a result of the volatility in the market. Those were put in place in spring of 2020, and they included a debt service reserve for 223F loans, a higher operating deficit, and working capital escrows for 221D4 loans. So the question is, when will we see those get back to normal? Is it third quarter, fourth quarter of this fiscal year? Is it vaccine dependent? As of right now, there really is no set date. It's a look and see attitude. They're monitoring it very closely, and we continue to work very closely with HUD headquarters just to understand when they may loosen the requirements. And as soon as we know, we'll let you know as well. So before we get into the major changes in the MAP guide, wanted to give some positive news as it relates to Davis-Bacon wages. So in 2013, they were required to start considering multiple wage rates, which we refer to as split wages, for new construction loans in certain situations. And this new guidance, it increased costs, the labor cost, and it brought on additional administrative burdens to borrowers and HUD alike. As a result of the work by the industry and the MBA, which included efforts by Steve Irvin and myself and others within Berkadia, in December 2020, the U.S. Department of Labor issued a clarifying memo that allowed more flexibility. This will result in one wage decision in majority of deals going forward. And so that's a big win for the industry and great for our borrowers just to keep the cost down. So now on to the MAP guide rollout. So as Steve said before, this is more of a revision of the 2016 MAP guide. It's not a major rewrite like the 2016 MAP guide was. It was published on December 18th, and it's effective for most deals on March 18th. It incorporates new and revised guidance from the past 4 years, and it added chapters for green MIP and closing as well. The first major rule that we're most excited about actually was introduced in early 2020, and it's what we all refer to as the 3-year rule waiver. And there's a little bit of history. Other than a brief period between 2010 and 2012, right after the financial crisis, HUD didn't really allow existing properties that were less than 3 years old to be refinanced through the HUD programs. In the brief period from 2010 to 2012, they did allow those to be done, but they did not allow any cash out. Now, in early 2020, when they put out the memo on allowing these deals that were 3 years old or less to be financed through the HUD programs, they included allowing cash out, and there are no loan to cost constraints that you might see in other loan programs, which to me is a real big piece of that, a big positive. There are some debt service reserve requirements that are similar to the COVID debt service requirements. Those do have burn-offs once you reach some programmatic debt service requirements. And in our experience so far, we've seen a lot of those meet that requirement upon closing, which is a big plus. It allows the borrowers to recoup some of their equity much quicker. So the 2020 MAP guide, however, they made this change permanent, and in our conversations with HUD just in the last week, they're extremely pleased with the results of this, and they believe that this is providing additional liquidity and flexibility for borrowers. In short, they call it a home run for the borrowers and for them. And just as a fact, Berkadia closed the first one in the country back in 2020, and HUD has reported closing at least 60 of those since the beginning of the program. Now I'll move on to green. So green MIPs. In 2016, when green MIP was introduced, Energy Star certification was what was used to qualify most existing properties. And since that time, HUD has found that Energy Star is a less reliable measurement of the true energy savings in a property. And therefore, they made the decision to discontinue allowing Energy Star certification for existing properties that were built more than 3 years ago. There are still other programs available out there that can work and work well. And the other upside is that they are still allowing it to be utilized for new construction, and at least for the next 2 years for properties built within the last 3 years with a score of 90+ required. As a part of this, they're encouraging us and having us encouraging our borrowers that do not use HUD for new construction to get the green certification when they build, so that when they come in refinance it via HUD, then it qualifies more easily using the HUD programs. So now I'll hand it off to Debbie, and she can talk about some more of the changes. Debbie?
Thanks, Bob. One of the changes we were glad to see was in regards to a look back for value. The 2020 MAP guide eliminated a requirement that limited the value that could be recognized for recently acquired land and properties. This rule in the 2016 MAP guide required the use of the lower of purchase price plus costs or the appraised value if an acquisition occurred in the last 3 years. So these restrictions have been completely eliminated in the new MAP guide, and HUD now allows the use of market value as supported by the appraisal. So this is really great news, because we know in many markets there are true increases in value within a short period, and now borrowers can get the full benefit of their equity when in recently acquired projects. There were also some changes to the statutory limits. So as we know, HUD programs fit a variety of project types, and while they don't come with income restrictions or only to finance affordable properties, HUD programs are also not intended for luxury high-rise condo type rentals. So to keep project costs in check, HUD applies a per unit limit for loan sizing that are calculated individually for each property. HUD has made several positive changes to the statutory limits calculation for 223F or refinance projects. The first one is the land value can be recognized at 100% rather than 85%. So there's been, for years, been ambiguity about this percentage, but this MAP guide cleared that up, and 100% is confirmed to be used for the statutory limits calculation. The second is a high cost multiplier can be used to increase the per unit limits in certain areas, but not only to increase the amount of cash out. So we have to be cautious of that. Cost not attributable, which is a calculation to give credit for the cost of the non-residential area in a project, can now be included in the statutory limits calculation for existing projects. So these additions can make a really substantial difference in the loan limits for existing projects in high cost markets. There were several changes in the new MAP guide to environmental requirements for you to be aware of. Choice limiting actions is the HUD term for actions taken on a site that could jeopardize the ability for HUD to finance the project. Typically, this comes into play for new construction deals, that need early site clearing or demolition of an existing structure. Disturbance to a property or site before the completion of HUD's environmental review raises concerns for historic preservation and SHPO clearance. After years of confusion regarding when a site is allowed to be disturbed in the early stages, HUD provided clarity in the new map guide. The map guide identifies submission of the HUD application for mortgage insurance as the trigger for the start of their environmental review. This new timing allows some actions to take place on a site prior to application and is more generous than previous guidance, which restricted any disturbance after HUD was made aware of the project. The key here is for us to discuss any plans for the site as early as possible so we can work with you and notify HUD as needed. So always ask. Choice limiting action rules also apply to existing properties. The new map guide has clarified that routine maintenance is an allowed activity during HUD's environmental review, and the definition of routine maintenance was expanded to include typical repairs less than $35,000 and life safety repairs. Larger dollar repairs must be done after the firm commitment. Regarding asbestos, the trigger date for asbestos testing was changed from 1978 to 1989. This new date is tied to an EPA ban on asbestos-containing building materials. The only exception to the trigger date is roofing materials, which can still be manufactured using asbestos. Consequently, there is a new requirement to provide verification of the composition of roofing materials for buildings of any age. This requirement can be satisfied by providing receipts, labels, or by sampling and analysis. The industry is working with HUD to find ways to modify this requirement, and we're hoping to make it less broad. There's two changes for radon in the map guide. Radon testing is now required for zones 1, 2, and 3 for 223F transactions. Previously, zone 3 was excluded from radon testing, but it's now required. And secondly, the previous map guide allowed the option to test 25% of ground floor units for the first round of radon testing. This option has been eliminated. The new requirement is 100% of ground floor units must be tested for the first round. HUD removed this option due to the unreliability of 25% sampling, according to industry studies. And it also was not uncommon that the testing resulted in a second round of 100% testing anyways. And lastly, we have new guidance on fracking, which has not been provided before. So if you have a project that has potential fracking near the residential site, please talk to the Berkadia team early so we can ensure that the requirements are met. So now Terry will talk about mortgage credit and repairs before getting into a lot of positive changes for the affordable deals.
Thank you, Debbie. For mortgage credit, the only change of note is in the treatment of EB-5 funds. Previously, HUD would grant a waiver to allow EB-5 funds to come in over time if the deal was affordable or had, quote, some public interest motivation, unquote. Now that waiver possibility is gone. The new map guide requires 100% of the EB-5 funds needed for HUD's cash to close to be deposited at initial endorsement, just like the rest of the sponsor equity needed for a market rate D4. However, if instead of equity, the EB-5 funds happen to be coming into the deal as debt, then HUD's secondary financing requirements apply, such as repayment from no more than 75% of surplus cash. In terms of repairs, HUD has come out with two changes for critical and non-critical repairs. The first is in regards to UFIS or accessibility repairs. Previously, HUD was more flexible in the timing of repairs related to bringing a project into full compliance with Uniform Federal Accessibility Standards, or UFAS. However, now HUD requires all UFAS-related repairs to be completed in conjunction with the HUD financing, usually as a critical repair. With this new requirement, HUD is basically saying UFAS requirements have been out there for a while now, guys. There's no reason why a property should not be in full compliance. So if you want a HUD loan with its great terms, you must do the repairs. And as a reminder, UFAS standards apply only to projects that have received some sort of federal subsidy, such as Section 8, home funds, or CDBG funds. A HUD loan only does not trigger UFAS compliance. The second change is related to bids for high-cost non-critical repairs. For non-critical repairs, HUD has increased the dollar amount of the repair that triggers the need for a bid from a qualified trade contractor. The old amount was $25,000. The new amount is $35,000. So keep in mind two things on this. These bids need to be provided to us and to HUD by closing. And two, bids are good for tightening up the repair escrow and thus reducing the amount of the completion assurance escrow, which is 20% of the total of the non-critical repairs. Yeah, so on to some great changes in affordable. Over the past 4 years, HUD has been willing to listen to industry requests in structuring of affordable deals, such as getting rid of unnecessary escrows and aligning its policies with the rest of the industry. The 2020 MAP Guide makes permanent a number of incremental changes HUD has made over the past 4 years and introduces a few other longed-for industry requests. We think all of these will have some positive impact on tax credit pricing and benefit the deal. The first change is one of our favorites. While HUD still requires at least 20% of the total equity to come in at closing, that 20% can now be made up of 10% equity and 10% equity bridge loan. This change aligns HUD's requirement with that of Freddie and Fannie without increasing risk and giving the deal a bit of a boost. The second change is in the maximum term of the equity bridge loan. The term of the bridge loan now may be extended up to 1 year after final endorsement for D4s, or up to 1 year after completion of repairs for heavy 223Fs. Previously, the bridge loan had to be repaid at final endorsement or at 100% completion of repairs. This change allows the large equity installment needed to repay the bridge loan to come in up to 4 quarters later, which should have a positive impact on yield and thus translate to more equity for the deal. The third change is another favorite and one I personally lobbied for at HUD headquarters a couple of years ago as chairperson of the MBA LIHTC committee. This one is the memorialization of HUD's acceptance of the fact that some tenant-in-place rehabs may not need a working capital escrow. For sub-rehabs, HUD requires a working capital escrow of 2% of the loan amount. However, if the project is a tenant-in-place rehab that is greater than 90% Section 8 or 90% or greater LIHTC, a waiver of the collection of the working capital escrow can be granted as long as evidence supports it. So in other words, if the property generates sufficient income during construction to pay for things that the working capital escrow is supposed to pay for, you don't need the working capital escrow. On a $10 million loan, this is a savings of $200,000 that you do not need at closing or now ever. The fourth positive change is in HUD's willingness to allow unused contingency funds and unused funds in the relocation escrow to be released to pay for deferred developer fee. Both of these amounts can be released at final endorsement when the escrows are no longer needed. All right, next slide, and I get to tell you even more beneficial improvements for affordable deals. The next change, a delay in the funding of the operating deficit escrow, has the potential to have an impact similar to the longer term of the equity bridge loan. For all new construction loans, HUD requires an operating deficit escrow of up to 3% of the loan amount to be funded at closing. However, now for LIHTC new construction, the operating deficit escrow may be funded much later, around 15 to 18 months later, depending on your construction schedule. So HUD now allows the operating deficit escrow to be funded at the time the HUD inspector signs the permission to occupy for the first building. So on a $20 million loan, this is $600,000 for which you need an equity installment much later in the deal. In terms of income averaging, HUD has now included income averaging in its definition of affordable housing. This ensures that your income averaging project can qualify for the lower MIPs of 25 or 30 basis points and use a lower vacancy of 5% and lower DSCR of 1.15 in loan sizing. When it comes to scattered sites, HUD is more than a little skittish. They want the collateral to be, quote, one marketable and manageable site, unquote. For market rate deals, having two sites separated by more than a block or a few blocks can be a tough sale. While this position is debatable, HUD still has a fairly rigid stance on this issue. However, for affordable deals, HUD is more willing to consider scattered sites, and these projects can be separated by a much greater distance. So, for example, you could roll up two projects that are, say, 1 or 2 or even more miles apart into one loan, one bond issuance, one set of reports, and one set of documents, thus saving several $100,000 on transaction cost on a 4% transaction. Some restrictions do apply, so let us know what you have in mind in terms of a scattered site project, and we will see if it fits in the box. Lastly, in the 2020 guide, HUD is more prescriptive when it comes to relocation plans for tenant-in-place rehabs. Newly added sections of the guide provide more details on what is required to be included in the relocation plan. Of particular note is the language that says a third-party relocation consultant should be hired. HUD takes relocation seriously, especially for vulnerable populations in the time of COVID, and they want to make sure things are done right and the tenants are protected. However, if you have a relocation specialist on staff to prepare the plan and oversee the relocation, that is acceptable in lieu of a third-party consultant, but the staff person should have the same experience and qualifications as a third-party consultant. And lastly, HUD promulgated a new relocation escrow agreement and requires that the escrow be funded in full at closing. But as noted previously, unused portion of the relocation escrow can be released and used toward deferred developer fee. When are we closing? The most important question after when can we rate lock? One positive outcome of the pandemic and all of HUD staff working from home is that HUD finally realized they did not need to have in-person closings. We're so thankful for this. This means no more sitting around HUD's office all day waiting to close. Closings by mail will now be the norm unless the deal complexity warrants an in-person closing. Another big step by HUD after much industry clamoring is new willingness to agree to a tentative closing date. The tentative closing date needs to be at least 60 days from the date of the lender's response to HUD's hello closing communication. While HUD counsel and HUD production staff still must review and approve the closing documents before setting the final closing date, the tentative closing date at least gives a little more certainty that we can relay on those bond calls with dozens of participants wondering when closing will be. And when working hard to meet any closing deadline, be aware that HUD is now requiring that the legal closing package be submitted no less than 30 business days before the desired closing date. So plan ahead. And we will help you do that by starting closing calls in advance of the issuance of the firm commitment so that we can get the legal closing package submitted as quickly as possible after rate lock. And finally, a few miscellaneous items of note. SPRA or BISPRA are now excluded from the calculation of HUD's inspection fee for all 221D4 transactions. So with a BISPRA deal, this translates to a savings of around $5,000 to $10,000 depending on the size of the loan. In terms of guest suites, HUD has now provided more explicit guidance. Two of the main requirements are: one, guest suites can only be provided as an amenity for residents. And two, the guest suites must be non-income generating. So in other words, no renting vacant units on Airbnb. That wasn't much of an option in 2020, but one day we'll all be able to travel again. And finally, some really fantastic news to make 2021 much better than 2020. HUD headquarters staff have told us there is serious consideration of lifting restrictions on the distribution of surplus cash. As many of you probably know, surplus cash can only be distributed 2 times per year. However, monthly distribution of surplus cash has been teased. So when will this be allowed? Well, as of last month, HUD headquarters staff told us they were waiting to discuss this with the new DAS, Ethan Handelman, before making any announcements. So as soon as we have a firm update on this, we will be sure to let you know. With that, Steve, turn it back to you.
Thank you. Bob, Debbie, and Terry, that was a fantastic update. I'm excited to close out the program with a Q&A with some previously submitted questions by our invited guests. As a reminder to our audience, please submit any questions using the Q&A button at the top of your screen, and we'll address them after the pre-questions that we had. I'll get us started with one question I'm especially curious about. I didn't hear any mention of opportunity zones. Is HUD still promoting deals in opportunity zones, Bob?
Yes, they are. They're still interested in doing deals in opportunity zones, and they do give those priority processing once they come in. They want to see those. One thing I would say is that when you're looking to do a deal in the opportunity zone, just double check your census tracts. From information I've received recently, there have been some changes, some slight changes to some of those, and so some may have shifted ever so slightly, but that is something they still want to see a fair amount of. And if you can put it with LIHTC or any other type of grants or what have you, that makes it even more attractive for them.
Sounds good. Thank you, Bob. With longer processing times that we're seeing right now, how are affordable deals with hard closing deadlines being treated, Terry?
Sure. In fact, we just had conversations with HUD leadership in the Western region just yesterday, and we posed this question directly to them. And we've also asked other regional heads what their stance on this is. And all the regions so far have expressed a willingness to prioritize affordable deals and opportunity zone deals that have a QOF investment. So we'll make sure that the deadlines are clearly communicated to HUD so that they know that a deal needs to go to the top of the queue. So those deals, in short, those deals are still going to get priority.
Sounds great. Despite all the improvements in throughput that we're hearing about, with HUD doing so many more loans, loan applications are starting to take a very long time. What do you expect timeframes to look like, Debbie?
Well, it's not new information to anyone that HUD is slammed, and it's not likely that they'll be able to catch up for quite a while. You know, it is, they have a backlog to catch up on. And so with HUD's limited options to change this situation and, you know, their ability to hire and to use their contract underwriter, you know, we don't have, we're doing what we have control over is to submit clean and thorough applications. So once HUD picks it up and it goes, that it will go through as smoothly and quickly as possible. So unfortunately, we don't have a good answer on what the timeframes will look like, but we do know that our work with the HUD offices and with headquarters, we're doing everything we can to help smooth out those timeframes as much as we can, and also submit really solid applications so that they go through well.
And Steve, I'll elaborate on that a little bit further too. There are obviously, because we have 5 different regions with HUD, they operate at different paces, just partly because of volume and partly because of personnel. If a deal is going into the Midwest region, it's probably going to go right into processing and review, and we would expect that a commitment would be issued within 60 days or less. That's been our experience. We've had some that have come out very quickly. I believe we had a 223A7 that came out in 11 days. So the mileage may vary. Other offices, the Northeast and Southwest and Southeast, they all have a significant amount of volume, and they are, you know, there's a lot more for them to get through. But we know from our conversations directly with them that they're working to get the contract underwriters more involved in deals, which is going to help get through those queues a lot quicker.
All right, that sounds great. So we have had several questions come in. Many of them are about exactly the topic we just discussed, but we do have one question, and we'll get back to timeframes after this. We do have one question from David Petroni asking, can a scattered site be a single family home? Terry, you're probably the right one to answer that.
Sure. The short answer is no. HUD is not interested in financing large subdivisions that are treated as rental. They really want to see buildings that have at least 5 or more units to them. So they do know this is an increasingly popular product type, but they don't feel like they are the best option for financing those. If that changes over the medium term, they will be willing to look at it, but they don't feel like they're equipped to handle it and don't have a good handle on that product type. And given the immense volume that they have right now, they just quite frankly don't have the bandwidth to try to get comfortable with it.
Okay. We have another question from David Waters asking, who can we contact at HUD to discuss insurance deductibles applied to wind, hail, and named windstorm? That might be a little granular for this panel, but does anybody have a quick update on that, or is this better to be taken offline, Bob?
That's a very specific question. We'll do some looking and get back to him on that. We'll get an answer.
Absolutely. And just one other thing, we have had several questions with regard to how long it's taking to assign underwriters at HUD. Bob, you answered that very clearly, that it's a little different in each region. And one thing that we know is we would expect with the implementation of this guide for the backups to increase over the course of the next week or so, just because people are trying to get deals in that have been underwritten using the old rules. So after that, things should start to smooth out. They should start to clear, and we would expect the wait times to go down. On a positive note, HUD has increased the capacity of their contractor, and that is a strong update, and hopefully that'll start to clear some of the backlog. We got another question. Is there legislation regarding the 3-year rule whose sunset could affect the now permanent 3-year rule waiver?
I'll answer that, and Terry, if you want to join in afterwards. Sure. We haven't seen anything specific. When the memo originally came out for the 3-year rule, it had basically a 2-year look back. They're gonna look at it after 2 years, and unless something legislative does happen, we don't expect it to change based off of the feedback that we've received from HUD headquarters.
Yeah, I don't think there. I mean, the 3-year rule change was not something that happened legislatively. It was more of just HUD requirements, HUD policy, rather than anything legislative. And they created the program for their own benefit. To be honest, they were seeing more and more construction loans, which they felt were the most risky of transactions, and they felt this was the 3-year, waiving a 3-year rule was a good way to still bring into the portfolio high quality projects, but not take on construction risk. So to them, it's a risk mitigation play. So, I think I can't imagine any legislation overturning it. I would be surprised, quite frankly, unless there's some horrible issues with it or there's some abuse, but I can't imagine anything overturning it.
Yeah, and one thing just to add to what Bob and Terry said, this was the removal of a previous restriction. It's not really a waiver of a rule. They removed a restriction that existed before. This is not showing any signs of going away. They weren't sure what to see or what they were going to see when it was started, but this is something that we kind of feel, and again, given what they've said, and calling it even a home run, it's highly unlikely to have this change, given that we're just about on the 1-year anniversary of when it was published. We've had several people ask about slides. I'll address that in a little bit, but we don't have any further questions. So with that, we'll bring our discussion to an end. Thank you all for sharing your insights, knowledge, and expertise with us. As we've heard today from the team at Berkadia, there's some changes that will affect and impact how we work, but we are confident we'll be able to apply them and have a great 2021 and beyond. Thank you very much to our panel, Bob, Debbie, and Terry, for sharing their insights. And a final thank you to everyone who joined us on the call. As a reminder, a recording of this webinar will be available shortly. A link will be sent to all of you who registered for this panel. As always, please don't hesitate to reach out to any Berkadia professional with questions or follow-up. They will either be able to answer those questions directly for you, or they will direct you to the right resource to get you the answers and insights you are seeking as you are looking for financing through HUD. We're here for you. Thank you and goodbye.